Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Howe, in for Jack Otter. Coming up, classes in session. The Dean of Valuation, Aswath Damodaran, is here to tell us which stocks investors should be looking at right now. And later, Wall Street getting a wake-up call this week, how investors can push past the market's recession fears. But we begin with our expert panel and 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Al Root, Megan Leonard, and Teresa Rivas. Al, first of all, if you think you're the only one between you and I who can grow a decent beard, you are correct. I want to ask you about the big stock sell-off that we're still building our way back from. We'll talk about the macro factors later, but you say you're appalled by the number of times you've been hearing the word crash. Go ahead and rage about that.
This week wasn't a crash. We had a bad Monday. The NASDAQ dropped 3.4%, something like that. We should reserve crashes for crashes. We're talking, 21% on the S&P, October 1987. We're talking 12% on the NASDAQ, March 2020, COVID. And to throw in the Dow, we're talking, down 8% for the Dow in 2008 amid the great financial crisis. Days like Monday in the U.S. happen about a dozen times a year. We can't have a dozen crashes a year, so it's not a crash. Now, even the Nikkei, the Japanese index that dropped 12% on Monday, creating all this havoc, it only ended the week down 2.5%.
So not a crash here, not a correction. Hiccup bordering on a sneeze is what I'm hearing from you. But what about corporate earnings? We're most of the way through the reporting season. What have we learned?
The markets have been volatile we're down 4 straight weeks. Earnings actually been pretty good. So we're now about 455 of the S&P 500 have reported. Earnings growth, 9% year over year.
That's good.
That's pretty good. Last quarter, earnings growth about 8%. Close to 80% of people are beating estimates. That's always the case, so that's fine too. The average rate,
they got to lower
always
them, then they jump over them, then they high five.
Yeah, half of the companies beat estimates. That's a disaster. And the average stock reaction is up a little bit, so you're beating and you're getting a bump. Now, there's always examples, right? Supermicro tied to the AI trade. They missed earnings. The stock went down 20%. Everybody freaked out. That was more about profit margins than even sales. 10% of their costs are NVIDIA chips, so those are getting pricey.
What are you going to be watching in the week ahead?
Week ahead, actually pretty interesting stuff. Home Depot reports, we get housing stuff. Now, they're coming off of 6 straight quarters of year-over-year same-store sale declines. Then we get Walmart. That gives us an indication on the consumer. And then we get CPI data on Wednesday. And we want a little bit of easing, not too much, so we get CPI Wednesday.
Okay, Megan, Google, Alphabet, lost a big antitrust case. Does that make it a dangerous stock for investors?
Well, Google didn't have a great week, and certainly the ruling didn't help any of that. But, I actually think the biggest financial risk, and my colleagues have been covering this, might actually be Apple. So it's interesting. Google was the default search engine on Apple devices, and Apple was actually paying Google for that, or Google was paying Apple for that, to the tune of like $20 billion. So this is not chump change here. And if Google is actually forced to give consumers a little bit more choice, with this ruling, it actually has already happened in the EU. It didn't make that much of a difference. So it turns out Google won't actually be hurt too much by this, but Apple could because it's no longer getting those pure play.
So I'm wondering if big tech monopoly judgments are like Lay's potato chips, where prosecutors are not going to want to stop at just one. Who might be next?
Well, Google is going to appeal this ruling, so we're going to hear more about this. They're actually facing another big lawsuit from state AGs around, you guessed it, monopoly allegations. But Facebook is also sitting there and seeing some action from the Federal Trade Commission. We've got Facebook on the chopping block. We've got Meta wanting to be broken up by federal regulators, and Amazon, and even Apple itself. So these are definitely a dime a dozen at this point.
Teresa, I want to talk about theme parks. Prices are up 39% since before the pandemic, and perks are disappearing. Take a look at this clip from a Disney YouTube video. My family used to watch this to get jazzed up for our Disney World vacations.
Flying into Orlando Airport? Then you get to experience Disney's magical express service. We can pick you up with our airport bus, drop your bags and you at your doorstep. Plus, with the drive off your mind, leave your worries behind.
But the free bus bit the dust, along with a lot of the other free perks that you heard about in that video. JP Morgan says expect a market share shift from here, in part because theme parks have gotten so expensive, toward cruise ships. Do you agree?
Yes, and you probably wouldn't have thought that a few years ago, since they're basically floating petri dishes. But it's hard to beat a good bargain. People did learn from the pandemic. They don't want to stop going on vacation, but they are very focused on value. And in terms of value, you just can't beat a cruise right now. It's definitely more bang for your buck than anything you can get on land, so it's not surprising that they're booming.
I think they said 20% cheaper than land alternatives versus it used to be 10 to 15% cheaper before the pandemic. So JP Morgan is bullish on Royal Caribbean. You've written positively about them. They're bearish on Six Flags. I want to ask you about airlines, though. What do you think, if there is a market shift going on here, what do you think this means for airlines?
Certainly. So there's about 3/4 of the U.S. population lives within driving distance of a port. And that's another thing driving people toward cruises, because nobody wants to go to the airport if you can avoid it, right?
You're saying people don't like airports? Is that what I hear?
I'm gonna go out on a limb, make a bold statement that people want to avoid the TSA, the delays, the crowds, and that's what's appealing about a cruise. It's a one-stop shop. You get on and your vacation begins immediately.
Makes sense to me. Thank you all. A rough week for the markets, spooking investors. The Dean of Valuation is here to weigh in on where you can find long-term returns. Next. Stocks ending on a higher note Friday, but down for the week after a volatile few days of sell-offs and rallies. The S&P 500 and NASDAQ tracking their fourth straight week of losses. Joining me now is NYU Stern School of Business finance professor and the Dean of Valuation, Aswath Damodaran, to tell us where to put our money. Hi, Professor. You wrote the book on asset valuation, more than one book, actually. Would you say that the U.S. stock market is attractively priced right now for long-term investors?
It's fully valued. It's building in expectations that things are going to work out for the best. And I think that might be the biggest risk you face. That if you're pricing in an expectation that inflation is going to come down, that the economy is not going to go into recession, then you're kind of setting yourself up for disappointment. But based on earnings and based on rates now, stocks look, in a sense, fully valued.
Tell me about big tech in particular. Investors worry whether growth is sustainable. Do you think big tech is too expensive here? And are there big tech names that are, that you find the most or least attractive of the group?
Here's the danger in avoiding big tech. I mean, Fangam a decade ago and Mag 7 in the last few years. If you avoid these stocks, you're missing the heart of the market. Just to give you a sense of the numbers here, during the course of the first week of August, the Mag 7 stocks lost $1.35 trillion in market cap. That sounds amazingly large, right? But if you look at the entire year, they've added, even with that loss built in, about $2.5 trillion in market cap. $2.5 trillion. That's bigger than entire markets. So much as people like to look at the Mag 7 and the Fangam stocks before that and say these stocks look expensive, they've been carrying the market now, not just for the last year, not just for the last 2 years, but pretty much for the last decade. There's something fundamental that's happened in the economy that's making these companies the places investors want to go.
Tell me about the sharp contrast between NVIDIA and Intel. Intel stock was recently down more than 60% for the year. So how do you tell whether a stock like that has gotten attractively priced or whether it's a value trap?
I'm a great believer in what I call the corporate life cycle, which is companies have startups, then you have young companies, you become a growth company, then you become middle-aged, mature companies, and then you go into decline. Right now, the market seems to be looking at Intel not just as a mature company, but as a company in decline. And I'm not sure that that fits. It's one thing to take a Bed Bath & Beyond or a brick-and-mortar retail company or even a tobacco company and say the future looks like it's negative. Revenues are going to shrink, your margins are going to go down. But Intel is in a sector where if it can find a pathway, and that's the if, I don't see why it cannot go back to being a mature company, not a high growth company. I think those days are done. There's enough opportunity in the space, and Intel has enough advantages to turn things around. So at this stage, if you're investing in Intel, the judgment you're making is the management team there in denial, in which case they'll keep doing what they're doing? Or do they understand that they need to fix their story, change the way they do business? And I think Intel might be one of those companies where if you're willing to make a bet on management, being realistic and bringing the company back, I think it might be a company that you might want to add on, much more so than NVIDIA at this point in time.
Interesting. Where do you stand on Bitcoin? Still over $60,000. Has it gained credibility just by staying this expensive for so long? And do you think investors should buy it?
You know what Bitcoin's biggest sales pitch is? That it's made a lot of people rich and a lot of people poor. It's developed its reputation entirely around speculative trading. Now, the reason I say that is I often talk to Bitcoin advocates. I'm not one of them. And I ask them what they think Bitcoin is. And I get one of two answers. It's a currency or it's a collectible. If it's a currency, it's not a very good one. I mean, I ask, even if you're a Bitcoin advocate, I have a question for you. When was the last time you used Bitcoin to buy something? A currency is supposed to be usable to buy other things. It's not been a very good currency because it's very inefficiently designed. As a collectible, people say it's millennial gold. The only problem is collectibles hold their value and everything else melts down. And Bitcoin, over every crisis I've seen in the last decade, has behaved like very risky stock.
Thank you, Aswath Damodaran. Nice speaking with you. Investors getting a wake-up call as markets whip through a turbulent week. We'll talk about the risks of recession and how you can best position yourself next. Panic hitting Wall Street this week as markets plunged at home and abroad, reminding investors to stay prepared despite seeing lofty gains this year. It's the Barron's cover story this week, written by Barron's senior writer Paul LaMonica. He joins us now. Paul, what the heck made stocks tank so violently? They're coming back now, but is it going to happen again?
I don't know if it's going to happen again. Hopefully not. This has been a lot of whiplash on Wall Street. This volatility, it started actually a week earlier because of concerns about weaker manufacturing data, weaker jobs reports. That really sparked concerns that maybe the Federal Reserve was behind the curve and needed to cut rates in late July. And now there are worries, do they have to cut rates more aggressively? You add the unwinding of the carry trade in Japan, which Al's going to talk a little bit more about what happened with the yen and people selling those Magnificent Seven stocks. Warren Buffett, one of those people actually, Berkshire Hathaway, unloading some of its Apple stake, continuing to unwind Bank of America. I think that added to the jitters, but I really think it's mostly about the economy and the sudden weakness that might be in the U.S. economy.
I totally agree with you, Paul. I really do think that we're starting to see that pivot from bad news is good news to bad news is actually just bad news. This is really interesting. The lower than expected jobs, that certainly started this whole train on the station, but we're going to start seeing these mixed signals now from the economy, and that's going to happen in things like jobless claims. So obviously at the start of the month, we saw those were a little bit down. That obviously sent folks into a little bit of a worry signal here, but they didn't do so bad this week, and it actually helped the markets rebound. So it's interesting. We'll definitely get the latest inflation numbers next week. That may be sort of, again, those mixed signals, but this is something we're going to have to monitor, and it could create some volatility in the near future for us.
Paul, what should investors do now? An economist told me this past week, it's too late to panic, so we can skip panicking. But what else should investors be doing right now?
Yeah, they panicked on Monday. You don't want to really panic at a time like this. You want that kind of level-headed approach. This is probably a time, though, to look at your portfolio and say, hey, I've got a lot of Apple and NVIDIA and Meta and all those other Magnificent Seven stocks. They've been living up to their name for the most part this year. They've been magnificent. So you unwind a little bit of that and you sell them and you buy things that maybe haven't done as well, particularly companies that have strong dividends as well that can do fine in a slowing economy. So staples companies, food in particular, Mondelez, Hershey, Campbell Soup, they look attractive. Some of the utilities, not the ones that have gotten the AI boost, the backdoor nuclear AI trade, companies like Constellation and Vistra, they're probably a little too expensive. You want Con Edison, NextEra, and then any dividend paying stock at a time where bond yields have come down.
Okay, Al, Paul mentioned the carry trade and Japan. We don't have the blackboard, we don't have the financial calculator, but tell us what it is and do we still have to worry about it?
So carry trade, right? You borrow something and sell it. You take that money, you go buy something else, probably with a higher yield. With Japan, you sell a low-yielding Japanese government bond. You take those yen, you go to the bank, you get your euros and your dollars, and you buy whatever you want in Europe and the U.S. Everything works out great unless currencies appreciate. Bank of Japan raised interest rates, currency started to go up. And it was just a shock, right? You wake up on Monday morning, you see Japan's index is down more than 12%. So I mean, it's a panic. What's going on? And with something like this, the real worry is like contagion, right? You find out, like Barry Knapp put it from Ironside's Macro, somebody hit the panic button. It was liquidation, right? So you worry about like some bank lent to a hedge fund and now they're in trouble, and then their creditors are in trouble, and you worry about contagion. I don't think you really have to worry about it because that Japanese market only ended the week down 2.5%. Everything sort of calmed down. People probably looked at their portfolios and adjusted.
Okay, Teresa, B of A says don't expect an early rate cut before the next Fed meeting. But bond yields have already come down. The mortgage rate is coming down. Could that be enough to give consumers a boost even without that Fed cut?
Yes and no. Right now it looks like no. We really haven't seen that much movement in the housing market. People who do have homes have been refinancing, but people who are still in the market are really sidelined because while yields have come down, housing affordability has been such a problem for so long, it's not really enough to move the needle.
Would you be refinancing a mortgage here?
Not right now. We've seen these moves happen before anything from the Fed, and presumably we hopefully have that to come in the future.
Too soon. Paul, we've got about 30 seconds. Do bonds look attractive? Yields aren't as juicy as they were. What should we be thinking about bonds here?
Yeah, I think on government treasury bonds, there still are some opportunities on the long end of the curve because you are getting decent yield and the appreciation as yields come down. But I think that corporates are looking a little bit more compelling, investment grade and maybe the highest end of junk. You don't want to get too far into low credit quality companies, but the double B area, that probably looks attractive. You got a couple of ETFs, the TLT and one from Vanguard, long-term intermediate bond fund that is also very attractive at these levels.
Junk, but the least junky part of the junk market, if I understand correctly. Thank you all. Teresa and Megan have a pair of investment ideas, and Al is telling us how Tesla is smartening up its self-driving tech. Stay right there. Al, I'm hearing a lot about robo-driving delays. I guess I shouldn't be doing this for robo-driving. Robo-driving delays at Tesla. But Tesla owners got a recent robo-driving software update, and you say it's the most impressive one yet. Tell us about it.
Yes, and I am one of those Tesla drivers. The reason, Barron's is sitting in their Tesla driving around doing tests and write these things because the stock is all about self-driving cars now. By Wall Street's math, it is a $1 trillion opportunity. And recently, Tesla delayed its robo-taxi day, when it's going to have these self-driving cars, competing with Uber and the likes on roads. They delayed it a couple of months, sent the stock down. But then they sent out this update. And we've been testing different versions of the self-driving software for more than a year. I've driven more than 1,000 miles, or to your point, let the car drive me more than 1,000 miles. It is a really good driver. It takes me to work and back without me ever touching anything very consistently. Our New England roads with little weird intersections, it handles them. And, the message is really, people wondering why is Tesla stock stable? The sales are falling, and why is the PE ratio expanding? Right now, it is all about self-driving. So we'll get to October and be ready. That's what you got to focus on.
Sounds like we're on our way. Teresa, you and Al recently teamed up to write about a stock pick. Do you want to tell us about it in unison? You can sing like I did earlier. Or, you know what, Teresa, why don't you just take this one and tell us about it?
I can't compete with that. So talk about driving and moving. Our pick this week is Parker Hannifin. It's not a household name, but if you've been in anything that moves, you've probably enjoyed its parts. A lot of people think of it as a stodgy industrial company that's not very exciting, but the earnings are exciting. They have new management, and there's a lot of things that could keep the stock going up.
Megan. How about you, stock pick?
TJX. So this, you know, is TJ Maxx, Marshall's, Home Goods, and let's be honest, spooky season is around the corner. They are going to kill it.
Spooky Halloween is what.
Halloween!
That's spooky.
Yes.
I didn't know if that was a financial retail term or something like that. Al, Megan, and Teresa, great ideas. Thank you. To read more, check out this week's edition at barrons.com. And before we go, congratulations to our producer, Jenny Bermudez, and her husband, Nico, who are welcoming their first baby, a girl named Rhea. Best wishes to the happy family. That's all for us. See you next week on Barron's Roundtable.